Good evening, everyone. My name is Evelyn. I'm a bond specialist from the bond desk. Together with me is Timothy Ang, the credit analyst from the bond desk as well. I will be going through all you need to know about wholesale bonds and how you can trade wholesale bonds with Phillip, while Timothy will go through the credit outlook for bonds. Before we begin, those who attended the Unit Trust webinar at 5 p.m. today, the host would like to inform the attendees that the webinar was ended abruptly due to technical issue. Okay, without further ado, Timothy will begin the webinar.
Okay, thanks, Evelyn. Thanks everyone for joining us today. So we'll just I'll be going through a brief intro into corporate bonds, and then the reasons why people buy corporate bonds, and then a brief overview over the credit markets as well. So just a disclaimer, so all this is just for educational purposes only. Next slide. Okay, so what are corporate bonds? Basically, they are just loans. They're investor loans, their money to a corporation. That's why it's called a corporate bond. So when you lend the money to a corporation, they'll pay you interest on your loan, and then they'll promise to pay back your loan principal at the end at the maturity date. So next. So you will receive your regular coupon payments for the money that you lend to the company. Usually it's paid out semi-annually, so 2 times a year. Then you receive your principal at the maturity date. So that in Singapore, in the Singapore corporate bond markets, there's 2 types of bonds that are traded. So one is wholesale bonds, and the next is retail bonds. So both are the same, but they have key differences. So wholesale bonds are traded in lot sizes of 250K, whereas retail bonds are traded in lot sizes of 1K. And also, with regards to trading, wholesale bonds are traded over the counter, whereas retail bonds are traded on the exchange. So just traded like normally, like stocks like that. So wholesale bonds are traded over the counter, meaning that between counterparties individually themselves. So that's the two differences between wholesale bonds and retail bonds. So one is traded on the exchange, one is traded over the counter, and they trade in different lot sizes. So if you look at it, in the wholesale bond market has around 370 wholesale bonds, compared to only about 4 retail bonds in the retail bond market in Singapore. We're talking about Sing dollar corporate bonds here. So you can see that the wholesale bond market is a much bigger market than the retail bond market. So the overall bond market is actually more catered and more dominated by institutional investors and high net worth investors. So it's one of the main ways that institutions actually generate income on their cash. It's how your insurance funds and all your endowment funds, how they generate a steady income on the cash that they actually manage. Right. So I understand that for many retail investors, 250K will be a bit quite a large amount to be locked up in a corporate bond. So we actually launched a new product called Bonds 50, traded in lot sizes of 50K. So we'll be touching more on that later with Evelyn. So why do people buy corporate bonds, right? First reason is because of the fixed income. So because you're promised your fixed coupon payments, and then you're promised your principal back. So your the cash flow visibility is very strong. You get to plan up. It's less volatile than stocks in general. The next reason is because they generally pay higher yields than other fixed income alternatives like fixed deposits and your government bonds. There's also lower penalties, so you can sell your bonds in the secondary markets for no penalty versus those fixed income, those fixed deposits. If you take it out early, you can lose your interest payments. And there's also, you can get better liquidity also because there's a secondary market trading for corporate bonds. And lastly, there's also capital gains that can be made with it. We'll talk about it next also. So next slide. So just an overview of the fixed income yields at the fixed deposit yields at the moment. So not sure if you can see it, but the fixed deposit rates for Singapore, this I got it from moneysmart.sg. The best fixed deposit rates range from about 0.8% to about 1.3% per annum for a holding period of about 1 to 2 years. Okay, next. So if you look at the Nikko AM, a Sing dollar investment grade corporate bond ETF. So this is the one corporate bond ETF that we have in the market. So it pays a yield of about 2%. But if you look at it, it only includes the investment grade bonds in Singapore. But actually, there's a very few investment grade bonds in Singapore. Main reason is because not many bonds are rated by the rating agencies like S&P and Moody's. So you have a very small selection of bonds in this ETF, and it also includes government bonds, which pay quite low yield. That's why we can see that it's only about 2% at the moment. So later on, we'll have a look at the more individual wholesale bonds. So if you look at it, the endowment funds, right, in Singapore, based on the SingSaver, is another fixed income security that a lot of people buy in Singapore. So endowment funds, it pays about, not sure if you can see, it pays about 2.1% for a 3-year holding period. Okay, next. So if you look at the wholesale bonds, these are some of the wholesale bonds, individual wholesale bonds that we have in the market. So the reason why people buy fixed deposit and endowment funds is because your funds are generally guaranteed by the either by the endowment funds or by the bank itself. So usually what people look at for corporate bonds, if they buy wholesale bonds, if they want the safety from, like, let's say, default and these kind of things, they look for a strong sponsor. So we show you the strongest sponsor that we have in Singapore, Temasek. So these companies, right, these bonds are actually Temasek has a very strong stake in these issuers. That's why the yield is pretty low. But even if you look at it with the backing of Temasek, the yield is generally higher than other fixed income assets. So it can range from about 2.5% to high 3%. So generally, you can see that corporate bonds pay a higher yield than other fixed income alternatives. Okay, next. Okay, and capital gains. So just to let you know that you can get capital gains also from corporate bonds. You can see that the blue line is the Nikko AM investment grade corporate bond index, the price, and the yellow line is the STI. So you can see that during the peak of the pandemic, actually the fall in the corporate bond index actually is relatively small compared to the stock market itself. So the volatility is much lower, and you can see that the prices are also back above pre-pandemic levels already. Compared to the STI, is still below pre-pandemic. So overall, you can get just to let you see that you can actually get capital gains from your bonds, even with all the safety that is involved compared to stocks. Okay, next. Okay, so that's the reasons why generally people buy corporate bonds. Is really for fixed income purposes, usually for retail investors in Singapore. So it provides very strong cash flow visibility. So just an overview of the credit outlook for now. So the key driving factor in the credit markets now is interest rates. So it's actually a positive now for bonds, because you can see on the chart, interest rates are actually at rock bottom. So it's literally at 0%. And the central banks are the ones that actually control the interest rates. So the reason why central banks are keeping interest rates so low at the moment is because it makes it easier for companies to borrow money. It makes it cheaper for companies to borrow money so that they can actually pull through this pandemic and this crisis. And so lower interest rates are actually positive for corporate bonds. Reason being that because government bonds pay so little yield, some of them even pay negative yields. So people obviously will move somewhere to look for yield somewhere else. And that will include corporate bonds that pay higher yield, and also dividend paying stocks. So there will be higher yield, higher demand for these higher yielding assets. So next. So what we see now for the outlook for interest rates is that it will remain low for a long time. So this is the US Federal Reserve dot plot. It's just the expectations of the US central banks on the interest rate level, which they control. So you can see that the expectations is at 0. It will remain 0 until at least 2022. But actually there may be changes to this. So next slide. So okay, so how the Federal Reserve determines their interest rates is by basing on 2 very key factors that they have to meet. So the first thing is the US unemployment rate. So right now the US unemployment rate is still very high, and one of the key roles of the Federal Reserve, the central bank, is to have full employment. So usually that So what their benchmark percentage rate is around 5%, 6%, the area. So currently now it's still above 10%. So is for to them, it's really not the time to raise interest rates at the moment. So the second thing they look at is actually inflation. So inflation, they have a target of 2%. Currently now, because of the pandemic, it's at around 1%. But if you look at the chart at the bottom, okay, next. Okay, so this is the inflation expectations. So from the peak of the pandemic, right, you can see that inflation expectations actually rose sharply. So they're expecting inflation to increase mainly because of the depreciation in the US dollar. So once the US dollar depreciates, it makes it more expensive for them to buy products from overseas. So because it costs them more money to buy things, the prices in the US are expected to rise also. So what actually is going to happen tonight is that the US Central Bank is going to have a talk at Jackson Hole. It's called the Jackson Hole Symposium. So the chairman for the US Federal Reserve will be giving a talk tonight, and they may review their policy on the inflation target to raise it higher, so that just in case the inflation rises too fast, they don't have to raise interest rates so fast. So they really want to keep interest rates lower for longer, and that's a positive for bonds. Okay, next. Okay, and the next thing, I think you all will have heard this already, since it's always in the news, but the virus is about the virus and the rebound in the economy. So it's really being talked a lot. Right now, the vaccine is actually the progress is very good. It's going very well. So in fact, they are expecting some of it to be approved by November this year already. So the markets are really looking at the post-pandemic economy right now already, and not really so focused on the virus itself. And another reason why they're doing that is because next. Because they're more focused on mortality rate now, is what we are seeing. More focused on mortality rate rather than the new cases. So you can see the gray line is the mortality rate, the blue line and the yellow line is the new cases. So more like the hospitalized numbers. So even though the hospitalized is increasing, the mortality rate is decreasing because of better treatment and detection. So the severity of the virus is actually declining, and that's why the markets are actually pricing that in. Next. Also in the UK, like the mortality rate fell from about 6.5% all the way down to 1.5%. So that's what the markets are really looking at the moment. So that's another positive for the markets is the virus. Okay, but one of the negatives that we see is not really a negative, but we see that the bond valuations now is already sharply recovered already, and is pricing in this post-pandemic recovery already. We can see that this the chart in the middle, the total return index for the bond for Singapore bonds, corporate bonds, is already past above the pre-pandemic level. So the blue line is the total return index, which includes the returns from coupons also. The red line is the moving average. You can see the price return index also. So this is just the price return, doesn't include the coupons. Also sharply recovered above pre-pandemic levels. Next. Okay, and another thing is the yield and the spreads. So what is a spread is that the spread is the yield of the corporate bond compared to the benchmark government bond yield. So it is the difference between the corporate bond and the government bond. So the bigger the spread, the more attractive the corporate bond is generally to the market because it pays so much higher yield than the government bond comparison. So right now we can see IG stands for investment grade. So investment grade is the spreads, right, is already tightened, is really quite low already. So it's below the 10-year average already. So we can see that prices are no longer in the cheap zone for investment grade. But if you look at the right, high yield, for the higher yield bonds, we can see that it's still above the green line, above the 10-year average. So it's still attractive in that area. So what we are seeing now is that, although generally speaking, we are no longer in the cheap zone, but the thing is that although valuations may not be cheap, there are still attractive bonds, but you have to be more selective. So next. So overall, just for this brief summary, so credit outlook, we're neutral. There's many good things that's happening for the bond market. So the interest rates lower for longer and the virus recovery. I'm sure that the stock market is also reflecting that already. So, but the risk is that the valuations are back above pre-pandemic levels already. So we are more selective on our picks now because of this the valuations factor. So later we'll talk more about our bond picks briefly. And then the second risk is that because the Federal Reserve is expecting higher inflation. So if inflation actually rises too fast, they may have to raise interest rates a bit earlier. So that will be a negative for the bond markets. So there's another risk that we look at. But overall, we are neutral on the bond market, and we are more selective with our picks at the moment. Okay, so that's all for our brief credit outlook. I'll pass on to Evelyn to talk about the technical side of corporate bonds.
Okay, thanks, Timothy. Okay, I believe you all already know what are bonds as covered by Timothy. So I will dive straight into why companies issue bonds. So there are various reasons why companies issue bonds. One of them is to reduce the debt levels. Companies may have existing loans that are due, and they have insufficient cash flow to repay the loan. They may also issue bonds if the prevailing interest rate environment is low, and the interest that they are paying for their existing loans are higher. Secondly, to offset the operating expenses, the funds raised may be used to help the business to cope with the day-to-day operations such that they are able to maintain or even improve productivity levels. The funds may be used for corporate acquisitions. If the company sees potential in another firm and intends to acquire the business, so they will have to raise funds for this. For business expansion, for example, a REIT could raise funds to purchase additional property for future rental. You may wonder why borrowers issue bonds instead of borrowing from the banks. Issuing bonds have several advantages over bank loans because it can be structured in many different ways with different maturities. By issuing bonds directly to the investors, they can actually eliminate the bank's middleman as the transactions. So without these banks, the borrowing process becomes more efficient and may also be less expensive. It is also less restrictive for the borrowers as they may be subject to stringent onboarding processes that banks have in place for any borrowers. So for the banks, it's like a precaution against risk, but for companies, it may be a barrier to action. So they rather issue bonds instead. Just an overview of the bond market. Under bonds, there are sovereign bonds and corporate bonds, treasury bills, which are also known as T-bills. They are short-term Singapore government securities issued at a discount to their face value. So these investors who buy these T-bills will receive the full face value at maturity. The government usually issues 6-month and 1-year T-bills, and these are issued by MAS and backed by the Singapore government. Singapore government securities are also under sovereign bonds. They are bonds that pay a fixed rate interest and have maturities from 2 to 30 years. So for both sovereign and corporate bonds, there are retail and wholesale bonds offered. Diving a little deeper into wholesale and retail bond, other than the amount, wholesale bonds are quoted on clean pricing and are traded on the OTC market, meaning there's no central exchange for these wholesale bonds. For retail bonds, they are quoted using dirty pricing and are usually traded on recognized exchanges such as SGX or HKSE. Wholesale bonds are quoted on clean pricing, so the price of the bond stated excludes the accrued interest. So if you refer to the order ticket above, you will see that the principal amount plus the accrued interest, which will give you the settlement amount. This is what it means by clean pricing. So an example on clean pricing, referring to this OLAM bond as an example, the X date for OLAM is 17 April 2020. And the previous X date is 17 October 2019. So if investor A sold his OLAM on 1st April to investor B, he will receive the accrued interest from investor B, because investor B will receive the full 6-month coupon from OLAM on the next X date. So investor B will be entitled to the coupons from 1st April onwards until the day he sells his bond. So to put all this simply, Investors who purchase wholesale bonds will be entitled to the coupons right from the day the bond is purchased all the way to the day he sells off his bond. So for dirty pricing, it's traded similar to equities. The accrued interest is already priced into the bid and ask prices. The settlement amount will be the price quoted on the bid or ask side times the quantity that you purchase. If you purchase, just like equities, if you purchase on the last day of CD, you'll be entitled to the half-year coupon. Likewise, if you sell on the last day of CD, you will not be entitled to the coupons. Some terms that you may want to familiarize yourself with before purchasing your first bond. Face value. Face value is the amount the bond will be worth at maturity. This is also the reference amount the bond issuer uses when calculating interest payments. For example, say an issuer issued their bonds at $100. An investor purchases a bond at a premium of 101, and another investor buys the same bond later when it's trading at a discount for $99. So when the bond matures, both investors will receive $100 as a face value of the bond. Coupon rate is the interest payments that the bondholder receives from the bond issue date until it matures. Coupon dates are the dates on which the bond issuer will make interest payments. So payments can be made at any interval, but usually issuers actually pay them semi-annually. Maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholders the face value of the bond. Issue price is the price which the bond issuer originally sold the bonds. Call date is the date on which the bond can be redeemed before maturity, subject to issuer discretion. For yield to maturity, YTM, this is the total return anticipated on a bond if the bond is held until it matures. So this is an example of how you read a bond. The first part shows the issuer, which is Olam, followed by the coupon rate of 6%, and the maturity, which is 25th October 2022. Under Poems 2.0, you will be able to see all the details of the bond. Bonds listed on the secondary market may be trading at a premium or discount. So when the issuer issues at 100, even though the bond has yet to reach maturity, it can be traded on a secondary market. A bond that is traded at a premium means that the price is higher than the face value of the bond. So for example, a bond that was issued at a face value of 100 might trade at 105, a $5 premium. Investors can buy and sell the bond before it matures. If the bond is held to maturity, the investor receives the face value amount at $100. Likewise, a discount bond refers to bonds that are trading below face value. When the bond is trading at the premium, the yield goes down and vice versa. Using the above as an example, Olam offered a 6% coupon rate at the time it was issued. Given that the current interest rate environment is low, buyers actually came in to somewhat push the prices up. When the prices are being pushed up, the offered yield actually goes down. This is because the buyers are already paying a premium for the bond. Hence, the total investment yield will be lower as compared to investors who purchase the bond at an issue price of $100. Likewise, when the price is trading at a discount, the offer yield goes up. Referring to SPH as an example, the coupon rate at the time of issue was 4.1%. Given that it's currently trading below face value, which you can see under offer price is 98.85, the offer yield shown is 4.41%, meaning that if you purchase this bond and hold it to maturity, you will get back your capital at par value, which is $100. And because you purchased it below par, taking everything into account, your yield will be 4.4%. Corporate bonds usually have rankings. This ranking system actually dictates the payout order in the event the issuer cannot meet its financial obligations. This is also known as a default. These are three of the common rankings: senior secured, senior unsecured, and junior subordinated. Senior secured bonds are usually secured to an asset. It could be a physical property. So when the issuer pegs the bond to a physical property, it means that if they are unable to pay the face value of the bond back to the investors on the date of the bond maturity, they will have to sell the property to pay off the bond. Senior unsecured corporate bonds are just like senior secured bonds with one significant difference. There's no specific collateral that guarantees them. So other than that, such senior bondholders enjoy a privileged position in the event of a default with respect to the payout order. So after the senior securities are all paid out, the junior unsecured debt will be next in line. This will be paid from the remaining assets. This is unsecured debt, meaning there's no collateral to guarantee the bond. Usually, such unsecured bonds only have the issuer's good name and credit rating as security. These are the three common types of bonds by structure: fixed rate bonds, perpetual bonds, and floaters. A fixed rate bond is a debt instrument with fixed interest rate coupons paid out over its entire term. Upon maturity of the bond, the holders will receive back the initial principal amount. If they fail to pay the principal, the issuer will default. For perpetual bonds, usually they have no maturity date. They may have a call date. This is subject to the issuer. The issuer may choose to redeem back the bonds after a specific period of time. Also, they have the option to never repay the principal and continue paying coupons perpetually. A floater is a fixed income security that makes coupon payments that are tied to a reference rate. The coupon payments are adjusted following changes in the prevailing interest rate in the economy. When the interest rate rises, the value of the coupons is increased to reflect the higher rate. Just to dive a bit deeper into benefits of bond investing, firstly, you get to bonds offer a stable income stream. For equities, dividends may be irregular and they are not guaranteed. So for example, in this situation, there are some companies that actually cut their dividends. But for bonds, they will still continue paying the regular interest as per the agreed terms on the date of issue. Secondly, you will be able to receive your principal upon maturity. If the bonds are held to maturity, bondholders, they will get back the entire principal. So bonds are a way to preserve capital while investing. We all know the importance of portfolio diversification. To not put your eggs in one basket, bonds are considered less volatile than equities. Having bonds in your portfolio actually help to spread out your risk. For credit enhancement or sweeteners, issuers may include this to entice investors to purchase their bond, which I mentioned previously, a secured bond which is pegged to a physical property. This actually gives investor a form of safety. So of course, bond investing comes with risk as well. There's market risk, credit risk, liquidity risk, and foreign exchange risk. For market risk, the value of the bond is subject to interest rate changes, as well as the demand and supply forces. Bonds in particular are sensitive to interest rate fluctuations, and the prices of bonds usually move in the opposite direction from interest rates. So despite this consideration, the risk is actually more pertinent if the investor decides to sell the bond mid-term and not hold it to maturity. Credit risk highlights the fact that the issuer may default on payment of the coupon and not return the principal amount back to the investor, or when the issuer encounters problem meeting its obligations. This is also known as default risk or issuer risk. For liquidity risk, when there is a lack of buyers and sellers in the market, the investor may not be able to sell off or execute the trade, and they may be forced to sell at a value that is lesser than what they wanted to sell. For foreign exchange risk, The investor is actually exposed to fluctuations in foreign exchange rates when they trade in bonds denominated in currency other than the currency that they have. This may erode the returns of the bond investment, especially if the exchange rate weakens against the original investment currency used when the bond is sold or when it matures. Some key considerations before you purchase a bond. Time frame, you may want to consider your liquidity requirement before investing in wholesale bonds and to match your investment horizon with the bond's maturity period. If you would like to conservatively invest money for a major purchase to be made within the next few years, you should consider holding a short-term bond. Likewise, if the timeline of your investment is longer, you may want to consider a longer-term bond. So longer-term bonds will typically offer a higher yield in exchange for the use of your money for a longer period. Having a predetermined time frame avoids the premature selling of bonds, which may incur a loss. Yield expectation. There are many clients who come and ask us to recommend them a safe but high coupon bond. It's very important for investors to understand that high risk comes with high returns and vice versa. There are many factors issuers take into consideration when issuing a bond. If they are issuing at an abnormally high rate, investors should be a little more wary. In addition, when prices are depressed in the secondary market and the yield goes up, investors should also find out what is causing the price to be depressed instead of buying just because the bond is cheap. Currency, which I mentioned earlier, if having foreign bonds in your portfolio actually helps to diversify your portfolio, but the higher returns expected from investing in these foreign bonds, it's also accompanied by increased risk arising from adverse currency fluctuations. So why trade bonds with Phillip Securities? The prices that are reflected on our Poems website is the final price that you'll be getting. So everything is priced in. We do not charge commission for bond trades. There's no processing fee and no platform fee. However, there's a spread of 0.25% for each buy and sell transaction. There's also a 0.05% per annum custody fee for foreign bonds held with us. Also, our bond desk provides access to over 200,000 bonds globally. So how to trade wholesale bonds? You may wish to get a quote from our bond desk directly or through your financial advisor or on our Poems 2.0 website under the Bonds tab. To place an order, you may submit your order on Poems 2.0 or through your financial advisor. How to trade wholesale bonds? For retail bonds, it's actually traded like stocks. So you all can just go EQ and key in the order. For wholesale bonds, it's traded OTC, but y'all can also place your wholesale bond trades online. If you don't have an account with us, the first step will be to open a trading account. With my info verification, the account should be ready in 2 to 3 working days. Upon logging in under LP1 Bonds tab, double-click for the order ticket to submit your order. Please ensure that you have funds in your account. The bond has just launched their first ever promotion. New and existing clients will receive 150 CapitaLand vouchers when you purchase your first wholesale bonds with us. So take this chance to explore the wholesale bond market and also to purchase your first bond. If you are not sure which bonds to look at, you may refer to our newly launched Phillip Model Bond Portfolio. This portfolio consists of wholesale corporate bond picks for fixed income investors. The list includes bullet and perpetual corporate bonds, which are denominated in Sing dollar. Please note that the prices are as of 18 August. If you want refreshed prices and details of the bonds, you can contact the bond desk directly. So just now, Timothy mentioned that for wholesale bonds, the lot size is 250K. For those who are looking for bite-sized bonds, we just launched our Bonds 50. Bonds 50 are are wholesale bonds that are traded in lot size of 50K instead of 250K. So this actually helps to free up the cash in your portfolio instead of spending 250 per bond. So if you have 250K, you can choose to purchase 5 different bonds. So this helps to provide a diversified bond portfolio. Our flagship list of Bonds 50 feature 5 bonds from a range of issuers, including blue chip companies from various industries. The list will be expanded as time goes on, or if you or if you have interest in any bond and you would like us to assess it and break it down, we can look into it as well. Some things you may want to note before trading Bonds 50. You are required to declare your accredited investor status as a requirement by MAS. As this bond 50 are odd lot sizes, you may not be able to transact in the open market. This means that the bid-ask prices may be quoted by us. The bonds are not transferable out of Phillip due to minimum denomination requirements by clearing systems. If you hold 50K of the bond, you will not have voting rights. Phillip reserves the right to vote on your behalf unless you accumulate up to 250 of that particular bond. Your account has to be a custodian account and has to be pre-funded before you can place your trade. For bonds that are 250K, we actually offer bond financing at 2.68% per annum. However, for this bonds 50, we are not able to provide financing. So in POEMS 2.0, there will be an indication shown for bonds that are offered under bonds 50. Behind the name, you will be able to see bracket bonds 50. So that's all from me. It's time for Q&A. Before that, those who do not have an account with Phillip, you can scan the left QR code to open a trading account with us. For existing POEMS account holders, you may scan the right QR code to subscribe to PhillipCapital Bond Desk mailing list. The Bond Desk actually sends out regular bond runs and bond-related research reports. So for further questions, you feel free to call us or email us. We will now move on to the Q&A portion. Feel free to type your questions under the Q&A section. You can post questions to myself or Timothy. Okay, I saw this question. Timothy, maybe you want to address this question. Let me just read it out. Many bonds have an allowance to reassess the coupon rates, SOR plus initial spread. How likely are companies to exercise this? Will it affect the company's reputation?
Okay, so this one refers to a perpetual bond. So basically, a perpetual bond is a bond without a maturity date. So they only have a call date, which is not compulsory for the company to redeem the bond on that date. So they may actually let the bond extend for a longer period. And when it extends, then they will reset the coupon based on the prevailing interest rate environment, which is the Singapore swap offer rate into SOR plus the initial spread, which is the spread of the coupon of the bond at IPO basically. So it's not whether they want to exercise this or not, but generally, if a company doesn't call a perpetual bond, it has a negative reputational impact on the company itself. So in the future, the company may view the investors may view the company's bonds in a more negative light. But that's just a view on the market. So it's not really a set in stone rule. Yep.
Timothy?
Evelyn? Evelyn, I think you're muted.
Okay, Tim.
Sorry.
Mm.
Yeah, I think I was muted. Okay, sorry, I just repeat myself. There's one client who asked any new bond issue which can be bought by retail investors at par. So for bond issues, we do open it to our clients, but these are usually in denominations of 250K. So usually we will only know from the issuer on the day itself. So if you are keen to participate, you can join our mailing list. Just scan a QR code, join our mailing list. We will send you an email. Then you can just indicate your interest. But it's all subject to balloting. If the demand is high, the chances of getting are low, just like IPO. Okay. Timothy, what would cause high yield bond prices to fall when interest rates are declining?
Okay, so interest rates are not only the only factor that affects bonds. So there are other factors also. So basically for high yield bonds, it depends. So if let's say the high yield bonds are denominated in USD, right? And the USD, let's say the USD fluctuates. So the currency will also affect the bond prices and the demand for bond prices. If they expect the USD to appreciate, then USD bonds will be more attractive also. Also, generally speaking, company fundamentals will definitely affect any of the bond prices involved.
Okay. How do you assess the risk of Singapore bonds, as most of these bonds are not rated?
Okay, so this one you have to look at the company fundamentals, so the numbers involved. Then you have to look at the credit ratios and the sponsors and the company outlook and this kind of things. So we do have credit research reports available. So you just have to, if you're an existing account user, you can join our mailing list, which will actually send out the bond reports on a timely basis as well.
Okay, thank you. Someone asked, must the client be an accredited investor to purchase an wholesale bond? If you make a purchase of the 250K lot size, you are not required to declare for now. But for the 50K, you are required to declare. Right, roughly how many wholesale bonds are traded in one day in Singapore? The number of wholesale bonds are around 370. Of course, there are other foreign bonds, but for Singapore itself, yeah, there's around 300. You want to understand how easy it is to buy and sell. For the liquidity wise, definitely it's not as liquid as equities. So usually bondholders, they purchase their bonds and expect to hold it till maturity. Because even for capital gain, there is, if you buy at 100 and it goes to 101, 102, but there's a there's a ceiling for the how much it can go up to. Because if the yield they are giving is, for example, 5%, if the prices go up to 105, it means that you are just foregoing the whole 1-year coupon. So usually people buy to just hold to maturity.
Okay, liquidity wise also, you have to look at the issue size. So depends on how much bonds the company issue in particular. So let's say a company issues about 500 million worth of bonds of this specific bond, then it will be much more liquid than, let's say, a bond that is only 50 million issued in the market. So that's another thing to consider, which is the issue size.
Yeah, and also because wholesale bonds are traded on OTC, the prices are not transparent to begin with. We won't know how much the bank traders are trading within their houses. Timothy, maybe you want to take this. The bonds are listed on POEM since launch date. How many have succumbed to any of the risks mentioned?
Which one? The bonds.
Among the bonds that are listed on POEM since launch date, how many have succumbed to the risks mentioned?
What risk mentioned?
The risks that I mentioned in the slides.
how many? Okay, among since the how many have succumbed to the risk mentioned? So basically, all bonds will be affected by the macroeconomic environment. So especially when COVID happened, all the bond prices also fell during that time when everybody was in a panic mode. So maybe the biggest risk will be default risk, which is really the worst thing that can happen for a bond holder. So that one is really not many. So in 2019 I think there was no defaults, and in 2018 there was about one or two defaults. So in Singapore, really the corporate bond market is pretty low default rate, especially compared to China.
Okay, thank you. Maybe Timothy, can you give an insight on buying wholesale bonds instead of buying bond funds or like bond unit trust?
Okay. Buying bonds as an individual versus buying bonds in unit trust, right? Okay. So the main difference is that bond unit trusts don't have maturity dates. So when you're looking to liquidate, let's say the price is below the price that you bought at, then at that point in time, cash flow visibility is lower because you may have to sell at a lower price. But for an individual bond, you can get you're promised the funds at a date and a maturity date. The other difference is that unit trusts have fees, so they deduct the fees from the bond coupons. Whereas if you buy a bond outright, there are no fees involved when you receive the coupon.
Okay, thank you. Some asked regarding the fees, which I mentioned, there's no commission, but there's a 0.25% spread. And for foreign bonds, there's a 0.05% custody fee for bonds that cannot be cleared through CDP. For the commission of bond 50, the commission is still 0.25, but because these bonds are in smaller sizes, the price, we may not be able to give you the price that is reflected on the exchange, which is 250. You may get a worse off pricing. So that's one of the downside. Okay. Okay, for the bond 50, who is the custodian? As I mentioned, before you can place for this bonds 50, you will have to open a custodian account with us and it has to be pre-funded. So Phillip will be the custodian for this 50K bonds. So there's one question on the bond financing. For the bond financing, we offer 2.68% per annum. If you want bond financing, you can speak to any of us or contact the bond desk. Then you can go ahead to open a margin account. But different bonds have different grading. For grade A, we offer LTV up to 70%. Grade B will be 50%. And there are grade C bonds that we do not offer financing at all. May I know if Sing dollar wholesale bonds purchased by us are kept in our CDP? If your account is linked to CDP and the bonds can be cleared by CDP, yes, your bonds can be kept in CDP. So only the bond 50, there's no option to keep the bonds in CDP. To trade bonds online, you can go to, let me just show the slide again. So upon logging in, you can go to prices LP1 there's this bonds tab. You will be able to see all the pricing. You can click issuer, then it will show you the full list of issuers and also the currencies and the bid yield, the bid price, offer yield, and also the offer price and the maturity date. How to see bond rating in poems? You can go to Phillip Bond's website. There's this margin finder. You can search the bond from there. Then we will provide the rating. If you are holding any bond and you want to inquire if we can actually offer financing, you can actually approach us directly. Timothy, you want to take this? Apart from Sing Dollar bond, what are the default rate for foreign USD bond on Poem's bond page or Phillip recommendation list?
For foreign bonds, we don't have a recommendation list at the moment, but the default rate for overseas bonds, this one I'm not too sure. So I don't keep track on the overseas default rates. But currently, okay, in the Great Financial Crisis, the default rate was around, if I'm not wrong, at the peak of the crisis, it was around 7%.
Okay, thank you. Let me just go through the questions to ensure that I don't miss any. First, the slides are presented here. Yes, it will be uploaded on Facebook, so you can rewatch the Facebook Live. Charges, I've already addressed the charges for purchasing a bond. From Joel, can you explain in further detail on the bond purchase menu? What is the nominal amount, indicative price? Let me just refer back to the trade ticket. Okay, you will be able to see the nominal value. Nominal value is the price where the issuer issued the bonds. The indicative price is the price that, the reason why it's indicative price is because wholesale bonds are traded on OTC exchange. So it's not as efficient as the equity market. So usually when we receive the order from clients, we will have to check with our counterparty if the price is doable before we fill the order. So in the order ticket, you can see the trade amount. The trade amount will be, for example, you see this 105.35 times 250K, you will get 263,375. Then there will be this estimated accrued interest, which I mentioned previously also. You will have to pay the seller the coupons when he held the bond. So because you will be receiving the next coupon, the next 6-month coupon. Then you add this two sum, it will be the settlement amount. Timothy, maybe you want to take this, where to get info about issuers that are starting to show trouble servicing bond interest.
Okay, this one will have to track their earnings reports and their announcements already. So you have to track the company quite closely. If you want to be ahead of the market, you have to have really be in track of the whole industry itself. So let's say if a property company, if property prices are going to drop a lot, then you know that property developers are going to have some trouble. So because another example is because of COVID now, right? Because of the construction restrictions, you know that construction companies are going to suffer a bit more during this crisis, along with the hospitality sector also. So that's, you keep track of the industry, and then you keep track of the individual company and their announcements. That is the fastest way. There are a lot of questions about the fees and charges. Maybe Evelyn, can you answer that?
Okay, I will repeat the fees and charges. There's no commission, but there's a spread of 0.25%. And for foreign bonds that are kept under our custody, there's a 0.05% custody fee. Okay, what does bid yield mean to the investor? So the bid prices and ask prices, it just means that if you sell at that pricing, what is the yield you'll be getting? Or if you buy at that pricing, what is the yield that you'll be getting when the bond matures? That's what it means. What happens to my bonds or funds if Phillip Securities go bankrupt? Not to worry, all these holdings are actually still in your name. So if anything happens to Phillip, you will still be able to claim back your assets. It does not belong to Phillip. Are we able to put in limit orders for bond purchase or sale? Yes, you can. You can refer to the prices that are reflected on the website, the Podiums 2.0 website, which I showed just now. If you see the price, for example, the ask price is 100, you can key in 99.5. But of course, if your prices are too far away, it's harder to get the order done. So to check whether your order is done, just check back at the end of the day. Usually, if it's not done, that means you will have to re-key your order the next day. Okay, I believe I've answered most of the questions. We will be here for another 10 minutes. For those who still have questions, please feel free to just type in the Q&A section. Else, that will be the end of the webinar. Thank you. We will still be here to answer questions, so just feel free to type in your questions. From Simon, does the price we ask include the spread? Yes, everything is priced in. If your order is done at 100, it means that everything is priced in. You will get the bond at 100.
Okay, there's a few questions about bond 50. So I can choose any of the 5 bonds. Yes, you can choose any of the 5 bonds. If you have interest in other bonds, you can let us know, indicate your interest, and we can add to the list. We can do a review and we can add to the list. For the commissions for bonds 50, so the spread will be the same. All the charges will be the same for bonds 50. So the spread 0.25. So let's say if you buy 5 bonds, like 5 of the bond 50, and then altogether becomes 250K, right? It's still the same fee, exactly the same as if you bought 250K of the exact same bond. So the fees are the same. Yes, so the spread of 0.25 is for buy and sell. So if you buy and sell, you'll be charged the spread twice. How do you participate in newly issued bonds? So for newly issued bonds, you can join our mailing list to get a heads up on the new issued bonds. Then you just have to let us know your order on the day itself. Then we will record your order and let you know based on the allocation of the bond whether you were allocated it or not. So it's pretty strict. It's pretty simple to take part in bond IPOs.
Olam bond with maturity in 2026 has dropped. Any reason?
Okay, for the Olam bond that was recently issued, the the yield has already dropped. So meaning that when they issued the bond, they had the indicative pricing of 4.25%. When it launched at 4%. So basically it was already at fair value, and then the valuations were a bit too rich. So that's why the prices didn't really rise that much after IPO.
What is a reasonable expected bond yield for retail investors during such times of low interest?
Okay, right now I think a yield of about 3 to 4.5% is quite reasonable already.
May I know how to join your mailing list? I flashed the page on the screen again. You can scan the QR code on the right to join our mailing list. So if that we will send regular bond runs, any new issue we will send to you as well. Any research reports. From Simon, is the allocation random or earlier subscriptions stand a better chance? Yes, the allocation is random. We will collate the orders throughout the subscription period. Then whatever we are allocated, we will just run a randomizer. So there's no preference. Timothy, in the bond 50, the average yield is about 3.5%. Is it better to buy a bond UT that also pays 3.5?
Yeah, you can buy a bond UT, no problem. So the difference is that a bond UT doesn't have a maturity date. So you're not promised your principal amount at a maturity date. So the cash flow visibility is a bit lower for the UT. And also I believe some UT only pay once a year. So but whereas corporate bonds they pay twice. So you have to take into consideration that also.
Okay. The last question, any plans for Phillip to offer fixed maturity bond fund product? This offers diversification benefits for investors who are keen on wholesale bonds and address one of the downside of bond funds. As of now, the bond desk, they do not have intention to start up a bond fund, but definitely we can look into this because Timothy just launched this recommended bond portfolio and also this bond 50. Of course, when we see the responses, definitely we are open to seeing what we can do with this and how we can provide access to the retail investors. That's why we are breaking down firstly to 50K so that it's accessible to more people. Yep, I believe all the questions have been answered.
Okay, maybe just check the chat also. So there's I think we can end off with just this question: what is bullet and what is how liquid is a perpetual wholesale bond in the OTC market? Evelyn, do you cover this already?
No. You can go ahead.
Okay, so a bullet bond basically is a bond with a maturity date. So they promise you your principal back at the maturity date. But for a perpetual bond, they don't have a maturity date. So they only have a call date. And a call date means that they don't have to pay you back your principal. They can choose not to, and they can choose to extend the bond. That's why it's called a perpetual bond. It can go on forever. So with regards to liquidity of perpetual bonds, liquidity wise is about the same. It depends on really the issue itself. So whether it's a large issue size or whether the issuer is is a very big company, it's a highly traded bond. So you have to really look at it from an individual bonds perspective. So but for overall bullet and perpetual bonds, liquidity is about the same. So for perpetual bonds, you usually will get a higher coupon rate for perpetual bonds because of the structure wise, because they can extend the bond, so they pay you a higher interest rate just for that, the poorer structure than a bullet bond. So you get a higher return for the higher risk involved.
Timothy, there's one last one from Simon. During this pandemic period where companies are not doing well, isn't it a higher risk to invest in bonds?
Yeah, for certain companies, yes. So yeah. So right now you have to look quite selectively at the companies that you're looking to invest in, especially for those that are more affected by the virus itself.
Okay, if there are no more outstanding questions, we will end this webinar here. Thank you all for your time. If there's any further questions that you did not get to ask, feel free to call us or email the bond desk. We will gladly assist you. Thank you. Thank you all.
Thank you. See you again.